Our economy is greatly influenced by debt. Debt is funding of business and boost production of businesses, making growth to the economy. Now debt is called liabilities in accounting. In my previous video, I have talked about the common asset account. As a continuation, this video will talk about common accounts of the major account, liabilities.
Just like assets, we need to have specific breakdown of liabilities in order to manage it well. We all know that liabilities are financial obligations, right? Now what will happen if we don't identify clearly our debt? One scenario would be you'll end up paying the wrong amount. Worse, you'll end up paying the wrong person. We need to manage liabilities well so that it will not haunt us in the end. So, we need to have specific liability accounts. Just like assets, liabilities also has two categories: current liabilities and non-current liabilities. Let's start with current liabilities. Current liabilities are liabilities that fall due within 1 year after the reporting date. In accounting, we have the so-called reporting date. This is the date of all your reports. Date of your reports can be located at the top portion of each business report. Reporting date is also called the cut-off date in accounting. So if you will pay your liabilities 1 year or below the reporting date, that liability is current in your report. One example of a current liability is accounts payable. Accounts payable are amounts due or payable to suppliers for goods purchased on account or for services received on account. Meaning, when you buy goods or services from suppliers and you pay your suppliers at a later time, now you have debt to your suppliers. Now that is accounts payable. Another thing, accounts payable is the opposite of accounts receivable. Another example of a current liability account is notes payable. Notes payable are amounts due to third parties supported by promissory notes. When you acquire debt and you give a promissory note promising to pay the debt amount at a specified date, this is notes payable. These are common current liability accounts. Take note, if they are to be paid 1 year or below the reporting date or cut-off date, then it is a current liability. Next, I will talk about non-current liabilities. Non-current liabilities are liabilities that do not fall due within 1 year after the reporting date. In other words, these are liabilities that are paid after more than 1 year. Therefore, if it is not a current liability, then it is a non-current liability. An example of a non-current liability account is loans payable. Loans payable are debts usually from banks or other financial institution. If you want your business to be funded, you can take a loan from the bank. That is a loans payable. Loans payable are usually paid for more than 1 year. Another example of a non-current liability is mortgage payable. Mortgage payable is similar to loans payable. These are debts usually from bank or other financial institution, but with a corresponding asset collateral. If you loan from a bank and you present your land as a collateral, then that is a mortgage. Mortgage payable. Again, mortgage payable are usually paid for more than 1 year.
So there you go. I have discussed the common account titles of liabilities. By this time, I hope you have an idea of current and non-current liabilities and what are their differences. Again, as a reminder, there are many specific current and non-current liability accounts. Please take note that a company can have as many current and non-current liabilities as much as they want. That depends on their needs and the definition of those liabilities. Just remember to properly classify a liability as current that is paid within 1 year after the reporting date, or non-current, which is if it is not a current liability, then it is a non-current liability.